Welcome back to the Forex Grade program. This is the first material we'll be treating, and then we call it Forex Trading for All. Forex Trading for All. It's a 53 pages book, and then we expect every participant to have gone through the book and study it through within a week. So we expect you to study through this within a week and ask your questions during our weekly live session. So the 53 pages, you can divide it into 5. That's an average of 10 pages per day. If you comprehend easily, you can easily finish this in a day. But you want to give everybody the chance to study through, regardless of your tight schedule, probably your work, your academics, or whatever. So let's get started. First page talks about what is Forex trading and then what is traded in Forex. So what is Forex trading and what is traded in Forex? As we have talked about Forex trading and the meaning of Forex trading earlier, we have talked about what is traded in Forex, currencies, and then currencies are always traded in pairs, such as Euro USD, Pounds USD, etc. So study the first page, get information, and during our live classes, you ask your questions. If you have any confusion anywhere, we provide solutions to them and we'll give you more clarity. So let's move on. The second page talks about the examples of the currency pair and what each of them is. The base currency, the counter currency, and the code, cross rates, etc. Page 6, we have commonly traded currency pairs: the country, the pair, the nickname, the symbol. Factors affecting Forex trading: economic factors, political conditions, market psychology, and then other information under that. How Forex trading works. So how does it work? You enter the trade, you make profit or you incur a loss. How does it work? So this page will explain that to you. And then we have market schedule. Tokyo, London, New York. Tokyo is in Japan, London in the UK, England, New York in the US. We have Sydney and some other markets like that as well. We have other cities too that are not mentioned here. Why trade Forex? Why trade Forex? Among different things that you can trade, why do you choose Forex? So these are part of the material we explain that to you. What do you need to start trading Forex? Your computer, your stable internet connection, you need some funds, and then you need a reliable and trusted Forex broker. For the Forex broker, which is very, very important. So you need a reliable and a trusted Forex brokerage. So the link to open your account to register with our recommended Forex broker will be provided to you. Register, do your KYC, and fund your account. And we get started from there. Forex codes. The hacks, offer, price, the bid, and ask. What does it mean? What do we call spread? All of these things are very important. So you get the meaning of all these things here and how they apply. And how to read Forex codes. How do you read Forex codes? The example here, you can see that this has 4 decimal places. this half, we have 5 decimal places instead of 4. So you know that your PIP, the calculation starts from the 4th decimal place. And then for other currency pairs as well that use 2 decimal places like this, some trading software will use 3 instead of 2. So you know that calculation of your PIP start from the 2nd decimal places. So that is that about that. What you mean by long? I've long Euro USD. I've short USD JPY. What does it mean? The first one means buy, the second one means sell. TP, take profit. SL, stop loss. Entry point. Another one is EP, entry point. So you study through to get the full information. So you get all this information here. Contract size, lot, and point or PIP. So what do we call contract size? The lot. And what do we call a PIP? Lot and PIP. So this will give you the standard lot, that's 100,000 units, the mini lot, and the micro lot. So you understand how those things works. It's very, very important. Yeah, you read this page where it's talking about what I just talked about, the 5 decimal places and then the 3 decimal places. It's supposed to be 4, where some trading software will use 5 decimal places. It's supposed to be 4, and where they're supposed to use 2, some of them will use 3. So you need to read on this page and get this information. Definition of long and short. I just talked about this. You should read here to get full information. Order type. So different kind of order type that we have. Market order, the stop order, and limit order. So read up this place for you to get the information, because you can enter your trade at any time. You can, just get to this page and then you understand how you can make your order. You can easily enter a supermarket, pay for any goods, like pick it and make your payment. And then you can also make payments, down payment, and tell them that, once you have produced this particular goods, send me 5 cartons. You make payment, and once they produce the goods, they will send you your order. So stop order, limit order, and the market order. Read on this page to get the full information. Yeah, read up here for more information too. Margin and leverage. Margin and leverage. This is very important. So what do we call margin? What do we call leverage? As a retail trader, as an individual that want to trade Forex, you go through a broker, and your broker will give you leverage. If they give you leverage ratio 1 to 100, that means for every $1 you have there, they give you times 100 of what you have. That means if you are trading with 1,000 naira and to trade, you have the ability to trade up to 100,000 naira. You get that? So if you open a position, if you make an order, you enter a trade with 10,000 naira, you can multiply what you are actually trading in the market times 100. So if your leverage is ratio 1 to 500, that means for every dollar you put in, into the trade, you're actually trading times 500 of that particular amount. This can be positive and this can be negative. This can be positive and this can be negative, because it will increase your chance of winning. If you, instead of you to make $1 as your profit, since you're using ratio 1 to 500, instead of you to profit $1, using leverage of ratio 1 to 500, you will be having a profit of $500. And if the market goes against you too, instead of you to lose $1, you'll be losing $500. That is what leverage means. That is what leverage means. So study through this and then you make your decision. But we don't recommend more than 500, ratio 1 to 500. Don't use more than 1 to 500 leverage, no matter what. Don't use more than 1 to 500. You use 1 to 400, 1 to 200, depending on your account size and your appetite for risk. But don't use more than 1 to 500. 1 ratio 500. Don't use more than that. There's some mathematics here that you may not understand at first, but as time goes on, you understand them. But the simple explanation is what I've given to you. So how do you calculate your margin? A lot of calculations here might get you confused in the beginning, but don't worry if you don't understand them. Once you study through, you may not understand them first. Just give it time. Once we have some live classes, I will shed more light on that personally. But check them through. If you're good in statistics, mathematics, or whatever, or economics, you can easily get through this. But don't try to understand everything at once. You get it? Don't try to understand everything at once. Go through over it again and again. So profit and loss calculation. Yeah, this is very important as well. But we'll give you just a short breakdown of this. You can just do something and just take your phone or your laptop, wherever, and Google the value of a pip for Euro USD. If you are trading Euro USD, just Google what is the value of a pip in dollar. It might give you $10 or 9.8 or $9.9. So you know the value of one pip. So when you are trading, when you are entering a market, when you are entering a trade, and then your take profit, you are envisaging 10 pips. You're envisaging the market to go in 10 pips higher. If you are buying, you're trying to go in 10 pips for profits for you. That means you multiply 10 by $10. That means your profit that you are looking at is $100. And same thing is applicable to your stop loss as well. If you want to set your stop loss to, and then you put your stop loss at 3 pip, that means, and you know the value of a pip is $10. That means you know that the value of what you are ready to risk is $30. You understand? So don't try to get it mixed up and get it confused. Just Google up any currency pair, USD JPY, USD CAD, Euro JPY. Just Google it, Euro JPY, the value of a pip for Euro JPY. It will bring it up, and then you can use that one to do your calculation. Now, let me talk about this. Here, I need to give you some information here, where you have your risk to profit ratio. Risk to profit ratio. Risk to profit ratio. You have to have your risk to profit ratio. Some people use 20 to 80, 20% to 80%. That means if they are envisaging like 8 pips at profit, they are not ready to risk more than 2%, like $2. They want to make $8 and they're ready to risk $2. But the rule, some will say 70-30. They're envisaging for every $7 they're envisaging to make in profit, they're ready to risk $3. But this is not the rule of thumb, because your account size will determine how much you can risk at a particular time for each of your trade. And that's why we have the safe lot table. We have the safe lot table that's going to help you out in this area. Instead of you to be doing some complex mathematics, the safe lot table will help you out on that. Let's move on. Read through all this. Take profit, stop loss, and trailing stop. TP, SL, TS. And that one is EP, entry point. Because After let's for an example, let's say I've done my calculation, I've done my technical analysis, and I'm entering a particular trade, and the trade is at 1.0526. I'm using that as an example. 1. Probably 1.1111, and I send the signal into the group for you, or I send it to a friend, and the friend too. I put the take your profit at a particular time, at a particular point, and then this is your stop loss. If that my friend wants to copy that my trade signal, that's what we call trade signal. So if that my friend wants to copy that trade and enter the trade with the parameters that I've provided, he or she may miss out on the market, may actually lose even when the trade signal is correct. Why? Because by the time I'm making my own trade, the time I was making my own trade, my friend might actually lose out. Even when the trade signal is correct. This is because, let's say I enter my own trade 8 o'clock in the morning, and then my friend see my trade signal by 8:05 or 8:30. That signal might not be useful for him anymore, because the market might have moved beyond where he's supposed to enter, because the entry point might have passed, and then the profit to be made might have reduced drastically, that if you enter that kind of a trade at that particular time, the risk associated with the trade might be too big than the profit he or she can make. So that is that. Just read through and then you get more information. Margin call calculation. Different brokers set different call their margin call. Yeah, and then when you read through this, you're going to understand what that means. And you get something that will some brokers will allow you to set your own margin. You can set your margin yourself, and some as the minimum you can set. They have the threshold they have set for their margin call. So what do we call equity? What do we call balance? What do we call profit or loss? What do we call margin? All those kind of things you have to read through and you understand. Interest, swap, rollover, calculation. So read through this for more information. Hedging